Equity Market Update, July 2022. Indian equities saw a strong rebound in July 2022 and Nifty 50 and S&P BSE Sensex rose by approximately 9% compared to a month ago. The rebound was driven by perception of US Fed likely to be less aggressive than earlier anticipated, fall in US yields, easing supply chain, sustained buying by FPIs in second half of the month, resilient domestic growth, softening in oil prices, etc. Large cap performance was largely in line with small caps, but underperformed mid caps during the month. Most major sectors delivered positive returns during the month, with metals, capital goods, consumer staples, and banking being the best performing sectors. Most major global equity indices, except China and Hong Kong, also ended the month in strong positive. FIIs turned net buyers of Indian equities in the month of July 2022. After 9 months of sustained outflows, FPIs bought net equity worth $0.6 billion in July 2022, following net selling of $6.4 billion in June 2022. On a cumulative basis, FPIs have sold equity aggregating $13.2 billion in first 4 months of FY23, compared to being net seller of approximately $0.9 billion during the same period last year. DIIs continue to remain net buyer and bought equity worth $1.3 billion during the month and has cumulatively bought $17.9 billion in first 4 months of FY23. Net inflows to mutual funds remained steady, stood approximately INR 26,000 crores in June 2022 and approximately INR 78,000 crores in Q1 FY23. Of the Q1 FY23 results declared, banks and NBFCs were better than expected, while that of pharma, cement, consumer staples, utilities and metals were largely in line with expectations. Results of IT, consumer durables and oil and gas were below expectations. Outlook: as on 31st July 2022, Nifty 50 was trading approximately 18.3x FY24 E-price to earnings ratio. While the valuation multiples are high compared to its historical average, it should be viewed in context to resilient economic recovery and robust corporate earnings outlook. Again, the ratio of India's market cap to GDP based on CY23 eGDP is approximately 93%, that is, within range of 60 to 100% in which it has traded during most of the last decade. The gap between 10-year GSEC and 1-year forward Nifty 50 earning yield is also higher than its long-term average. Moreover, corporate earnings growth is likely to normalize from FY23 onwards. Thus, on an overall basis, markets appear reasonably valued. Moreover, the valuations gap between the current valuation of many sectors have reduced compared to their long-term averages, and for many sectors, valuations remain above its long-term averages. In view of the above, while markets hold promise over the medium to long term, one should moderate return expectations in the near term. Outlook for the market is likely to be driven by expected growth in nominal GDP and corporate earnings growth. Optimistic domestic growth outlook, steady corporate profitability, growth supportive policies, etc. bode well for the economy and equity markets over the medium to long term. Accelerated monetary tightening, sharp increase in US yields, elevated inflation and commodity prices, slowdown in China, FPI's outflows, etc. are key near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.